Kia ora everyone, it's Mary Jo here, Kiwibank Economist. So it's fair to say that central banks around the world have been pretty busy this past year, and the Reserve Bank of New Zealand is no different. So far they've cut the official cash rate down to a record low of 0.25%, they've removed the LVR ratio restrictions, and for the first time ever in New Zealand, they've engaged in what's called quantitative easing, where they've set out to buy $100 billion worth of government bonds. Now these actions, as well as the other little bits and pieces the Reserve Bank has done, has led to lower interest rates in the economy, and importantly, has helped to keep the supply of credit flowing. So for those households and businesses impacted by the lockdown, the extra money in their back pocket and the easier access to capital because of these policies have hopefully helped them through these difficult times. But unfortunately, we're not out of the woods just yet. The outlook for the New Zealand economy remains weak, so even though fiscal policy is the most effective policy to get us through this recession, the Reserve Bank has been quite clear that they're not yet finished. In fact, they want to see rates even lower. You see, the Reserve Bank has a dual mandate that they need to meet: to support employment at a sustainable level and to maintain price stability by targeting an inflation rate close to 2%. Now the problem here is that the unemployment rate is expected to rise to about 8-9%, and a period of deflation, which is a 0% inflation rate, is the greater risk we face here. So with that in mind, more policy stimulus from the Reserve Bank is needed and is indeed expected to come. So what's next? Well, the Reserve Bank have flagged this idea of a package deal consisting of a negative official cash rate and a funding for lending program. Now, we're not big fans of a negative OCR, but we do like the sound of the funding for lending program. And in a positive development, the Reserve Bank has signaled the possibility of deploying this package in 2 stages, beginning with the funding for lending program, which could be available to banks to access by the end of the year. The Reserve Bank could then take the official cash rate into negative territory, minus 50, maybe minus 75 basis points by early next year, although they don't necessarily have to take that second step. You see, the funding for lending program in and of itself is sufficient to lower interest rates in the economy. So how would that work? Well, in a nutshell, the Reserve Bank would be providing banks with really cheap loans. Essentially, a bank would take out a loan from the Reserve Bank at a rate close to the OCR, possibly lower, so really cheap funding. The banks would then on-lend that to customers at a similar rate. So with a lending facility like this, it would support borrowing, and we could see lending rates, like mortgage rates, fall even further. Now, a funding for lending program is also a surefire way to reduce retail deposit rates. And that's because with a guaranteed source of funding, banks wouldn't have to compete for other sources of funding by offering high deposit rates. So again, with a lending facility like this for banks to access, we could see deposit rates fall substantially, close to the 1% rate. Now with lower interest rates, it should help to generate some inflation in the economy by putting downward pressure on the exchange rate and lifting asset prices. But perhaps more importantly, pushing interest rates even lower will help to bolster the demand for credit, which has been weak, understandably, but then would see a pickup in investment activity, and that would really help the economy get going. That's it for this weekly wrap up. I'll talk to you in the next one.